Okay, this week we're in Chapter 7, Types of Inventory. Physical inventory, the actual count of goods in units and dollars. Perpetual inventory, also known as book inventory. Based on accounting books or records, it gives the buyer the total retail value of stock at any time. And I wanted to give an example of calculating by computer systems. For example, I have a Shopify store. When I get inventory, I enter the SKU number and the quantity for each item, and Shopify keeps track of inventory as it sells. The benefit is that since I sell cross-platform, I sell both in my store and online, I can make sure that if something sells online, I can go and pull it from the rack before someone buys it in the store. And same thing, when somebody buys something in the store, I can remove it from my online inventory. That way it doesn't it doesn't happen where something sells twice, where it sells both online, but it also had already sold in the store, and then I have to cancel an order and refund someone. So that's one benefit of having keeping track of your online inventory. There are a lot of advantages for retail. Managing a fashion business is notoriously complex compared to other retail sectors, making real-time inventory tracking incredibly important. Other reasons are the nightmare of massive SKUs. In fashion, a single t-shirt isn't just one product. If it comes in 3 colors and 5 sizes, that's 15 distinct stock keeping units or SKUs for just one style. Multiply that by hundreds of styles across several store locations and a warehouse. Without a continuous automated system, keeping track of which specific size, color combinations are in stock is nearly impossible. Fast-moving trends and seasonality. Fashion is incredibly fickle and seasonal. What flies off the shelves in April might be dead weight by July. The benefit of keeping track of your inventory is real-time data shows managers exactly which styles are hot right now. This allows them to quickly reorder popular items before they sell out, or put slow-moving items on promotion before they become obsolete at the end of the season. Preventing shrinkage and theft. Because clothing is highly accessible and easy to conceal, the fashion industry struggles heavily with shrinkage, theft, damaged, or misplaced items. The benefit of having perpetual inventory and physical inventory, by having a continuous paper trail of exactly what should be on the floor at any given second, retailers can pinpoint exactly when and where items are going missing, rather than waiting for an end-of-the-year audit to realize they've lost thousands of dollars. Okay, so there are a lot of formulas here. So all the formulas in the slides are going to be really handy. So the formulas are going to be all in orange on the slides. And you're going to want to refer back to them while you're working through the problems today. Because basically, all we're doing here is using the formulas and plugging the numbers in. So first we have calculation for book inventory. Book inventory equals the total merchandise handled minus the retail deductions. When utilizing a perpetual inventory, it is important that extensive records are maintained because everything that affects the value of the inventory must be reported. Calculations of book inventory. Transactions that increase the value of the inventory include purchases, transfers in, customer returns, markdown cancellations, additional markup. Transactions that reduce the value of inventory include return to vendors, markdowns, revisions downward, transfers out, and employee discounts. All right, here's another formula. Total merchandise handled. Calculating total merchandise handled. Total merchandise handled equals beginning inventory plus net purchases plus net transfers plus net price revisions. Beginning inventory. When available, use physical inventory because it is more accurate than a book inventory figure. Net purchases. Returns to vendors, or RTVs, are subtracted from gross purchases. Net transfers. Merchandise is frequently transferred between stores and may be transferred between departments. A transfer in is treated like a purchase. A transfer out is treated like an RTV. Here's an example problem. Determine the value of total merchandise handled from the following figures. All right, so again, you're going to want to refer back to your formulas. Total merchandise handled equals beginning inventory plus net purchases plus net transfers plus net price revisions. So here's how we solve it. $20,000 opening inventory plus gross purchases $10,000 plus transfers in $150 plus additional markup $64 equals $30,214. Next, we take the RTV $450 plus transfers out $350 plus additional markdown cancellation $16, and we get $816. Next, we subtract $30,214 minus $816 equals $29,398. Okay, more formulas. Retail deductions. Calculating retail deductions. Retail deductions equal net sales plus net markdowns plus discounts to employees and other special customers. Make sure you keep note of the formula. Most of the practice problems that we're going to do, just a heads up, don't give you the net sales and you have to calculate it. Net sales. Customer returns and allowances are subtracted by from gross sales. Net markdowns. Markdown cancellations are subtracted from markdowns. Discounts to employees and other special customers. These discounts reduce the amount of sales that can be achieved from inventory, thus they must be treated as deductions from total merchandise handled. Okay, here's another example. Calculate the total deductions in the closing book inventory from the following figures. So again, we're just plugging in the numbers from the formulas. So we take 29,398 total merchandise handled, and we add $642 customer returns and $76 markdown cancellations, and we get $30,116. Next, we're going to add up $9,870 of gross sales with $380 of employee discounts plus $936 markdowns, and we get $11,186. Next, we take $30,116 and we subtract $11,186, and we get $18,930. Okay, so let's go ahead and we will go to page 177, and we're going to do practice problem 7.1, number 2. So you can pause this here and work the problem yourself on your own, and on the next slide is the answer for how to solve the problem. And on the next slide, it goes step by step through to show you how to solve it by plugging in the numbers into the formulas. Here is the solution. So the question says calculate total merchandise handled and B closing book inventory given the following information. Calculation of shortage. When the retailer takes a physical inventory, the actual value of the inventory as determined by the physical count is compared with the book inventory and adjusts the books so that they agree with the physical inventory. Shortage or shrinkage occurs when book inventory is larger than physical inventory. Overage occurs when physical inventory exceeds book inventory. Okay, another formula. Make sure you take note. Shortage percent equals the amount of shortage divided by the net sales. Causes of shortages include theft, breakage, incorrect measuring and weighing. This one I can tell you has happened to me since I sell on Etsy. If people did not measure the package or the weight of the item correctly, it can cause me extra costs because I get charged extra by the post office for not putting the right weight in for shipping. Also giving samples, improper handling of sales transactions, incorrect counting of merchandise, failure to record merchandise on loan. Here's another example problem. During the spring season, February 1st through July 31st, the lingerie department had net sales of $350,000. On July 31st, a physical inventory showed $87,110 worth of merchandise. The book inventory showed $92,610. What was the shortage percent for the season? If the book inventory is more than the physical inventory, you have a shortage. If the physical inventory is over the book inventory, you have an overage. So the solution, shortage equals book inventory minus physical inventory. $92,610 minus $87,110 equals $5,500. Shortage percent equals shortage amount, $5,000, divided by net sales, $350,000, which equals 1.57%. Next, go to page 180 and let's do practice problems, just number 2 in section 7.2. So you can pause this here and work through the problem on your own. On the next slide, I'll show you step by step how to solve the problem. And again, it's just plugging in the numbers using the formulas. Estimated shortage. Calculating estimated shortage. Here's some more formulas here in orange. Make sure you take note of these. You'll need them for the problems. Estimated shortage equals net sales times estimated shortage percent. Estimated physical inventory equals closing book inventory minus estimated shortage. Estimated shortage is the amount of shortage that has probably occurred based on past experience. Estimated physical inventory is the value of inventory as determined from records after adjusting for estimated shortage. So here's an example problem. Calculate A, estimated shortage, and B, estimated physical inventory using the following information. A, estimated shortage equals net sales 76,000 times estimated shortage 1.60% equals $1,216. B, estimated physical inventory equals closing book inventory minus estimated shortage dollar amount. The opening inventory $16,400 plus net purchases $84,300 equals $100,700. Net sales $76,000 plus net markdown $3,600 plus employee discounts $2,200 equals $81,800. $100,700 minus $81,800 equals $18,900 minus the shortage $1,216 equals $17,684. Estimated, this is calculated using the numbers in your books, not counting, just to estimate inventory. Book inventory. The value of the inventory as determined from records rather than a physical count. Physical inventory. The value of the inventory as shown by an actual count of merchandise. Estimated shortage. The amount of shortage that probably has occurred on the basis of past experience. Estimated physical inventory. The value of the inventory as determined by book inventory after an adjustment has been made for estimated shortage. Okay, now let's turn to page 182 and we'll do practice problem 7.3, number 3. Again, you can pause here and work through the problem, and then on the next slide, I'll show you step by step how to solve it. Sales are made and reported in retail values. Yet the calculation of profit and loss requires knowing the cost value of opening and closing inventories so that the cost of merchandise sold can be calculated. Methods include the retail method and the original cost method. A procedure whereby the approximate cost value is determined from the retail value, used by most moderate and large-size retail firms, allows for the depreciated value of markdown goods to be reflected in cost value of the inventory. Steps in calculating inventory valuation. 1. Calculation of total value of merchandise handled at both retail and cost. 2. Calculation of cost percent of total merchandise handled. Cumulative markup can be calculated. So again, please take note of these formulas in orange letters here. Cost percent equals cost of total merchandise handled divided by retail of total merchandise handled. Calculation of closing book inventory at retail. Closing book inventory equals total merchandise handled divided by total retail deductions. Steps in calculating inventory valuation continued. Calculation of approximate cost value of closing book inventory. Cost of closing book inventory equals retail value of closing book inventory times cost percent. The preceding steps give the complete inventory valuation at cost. However, 2 more steps are necessary for determination of gross margin. Calculation of gross cost of merchandise sold. Maintained markup can now be calculated. Gross cost of merchandise sold equals the cost of merchandise handled minus the cost of ending inventory. Calculation and total cost of merchandise sold. Net cost of merchandise sold equals gross cost of merchandise sold minus cash discounts. Total cost of merchandise sold equals net cost of merchandise sold plus alteration costs. Calculation of gross margin dollar amount and gross margin percent. Gross margin dollar amount equals net sales minus total cost of gross margin. Gross margin percent equals gross margin dollar amount divided by net sales. Original cost method of inventory valuation is used by stores with slow turnover or small inventory in comparison to sales volume. Based on maintenance of book inventory at cost, an alternative method of maintaining book inventory at cost is to refer to the vendor's invoice for cost information as items are sold. This method is appropriate only when the number of transactions is limited and items have a high unit value. Advantages of RIM. It allows for more efficient merchandise management, is more accurate, may be less expensive, and is more flexible. Disadvantages. Extensive record keeping, complex and time consuming, may result in a cost value that is not an exact figure. Suggestions for working RAM problems. Before starting to work a problem, determine in which part of the problem each factor will be used. RAM problems can also be done on paper in any computer laboratory or on a home computer. Utilizing a computer spreadsheet makes it easy to do what-if problems. So now we're going to turn to page 194 and do practice problem 7.4, number 2. You can pause this video and work the problem, and on the next slide I'll show you step by step how it's solved. Gross margin return on inventory, GMROI, is a ratio measuring efficiency of the investment of inventory. It's calculated by dividing the dollar gross margin by the average inventory at cost. Average inventory at cost is calculated by adding the beginning of the month BOM cost inventory for each month in the period plus the end of month EOM cost inventory for the last month in the period and dividing by 7 for a season or 13 for a year. GMROI equals gross margin dollar amount divided by average inventory at cost. Here's an example. Calculate GMROI for a 6-month season from the following data. Here's the solution. Step 1, find the average cost of inventory. Step 2, divide gross margin by the average cost of inventory. As discussed in Chapter 5, cumulative markup is based on total merchandise handled and maintained. Markup is based on gross costs of margin sold. Cumulative markup dollar amount equals retail of total merchandise handled minus cost of total. Cumulative markup percent equals cumulative markup dollar amount divided by retail of total merchandise handled. Maintained markup is calculated using gross cost of merchandise sold. Maintained markup dollar amount equals net sales minus gross cost of merchandise sold. Maintained markup percent equals maintained markup dollar amount divided by net sales. Now let's do practice problem 7.5, number 3 and number 4 on page 196 through 197. You can pause this video and work through the problem. I'll show you excuse me, the solution on the next slide. Sorry, something in my throat. Okay, next slide. Okay, so that sums up the lesson for today.